Welcome to Chapter 14, Financial Statement Analysis. In Chapter 13, we built valuation models from assumptions about revenue, margins, growth, reinvestment, and risk. This chapter asks a very practical question. Do the financial statements support those assumptions? Financial statements are not merely accounting reports filed because somebody in Washington enjoys paperwork. They are evidence about how a business earns money, uses capital, finances itself, converts sales into cash, and survives difficult periods. They also contain estimates, classifications, and management judgments. The numbers matter, but so do the accounting choices that produced them. That distinction is important because reported earnings and economic reality can separate. A company may report growing net income while receivables or inventory absorb cash. A highly leveraged firm may post an impressive return on equity because the equity base is small. A business may call an expense temporary for several years in a row, which is an unusually durable form of temporary. Market history has supplied expensive reminders. Enron's reported performance looked far healthier than the underlying obligations and transactions ultimately justified. WorldCom used accounting choices to make ordinary costs appear more like long-lived investments. During the financial crisis, investors learned that balance sheet structure and funding liquidity can matter more than a smooth earnings trend. The lesson is not that every accounting estimate is suspicious. The lesson is that analysis must connect income, cash flow, assets, liabilities, and footnotes into one economic story. This chapter covers the income statement, balance sheet, and statement of cash flows. We will calculate and interpret return on assets, return on capital, return on equity, margins, turnover, liquidity, and leverage. We will use the DuPont system to explain why return on equity is high or low. We will also examine comparability problems involving inventory methods, depreciation, inflation, unusual items, and earnings management. The goal is not to collect ratios like trading cards. The goal is to use them as questions. What changed? Why did it change? Is the change sustainable? Did profit become cash? Did growth require more capital? Did leverage improve the result or simply make it more fragile? A spreadsheet can calculate every ratio in a few seconds. It cannot tell us whether management earned the result, borrowed it, or merely scheduled it. That is where analysis begins. By the end of this module, students should be able to do 4 things. First, describe the 3 major financial statements and distinguish accounting earnings from economic earnings. The income statement reports revenues and expenses over a period. The balance sheet reports assets, liabilities, and shareholders' equity at a point in time. The cash flow statement explains how cash changed through operating, investing, and financing activity. Accounting earnings follow accrual rules. Economic earnings ask how much cash the firm could distribute without damaging the productive capacity needed to continue the business. Second, calculate and interpret profitability, turnover, liquidity, leverage, and market ratios. The important word is interpret. A current ratio of 2 is not automatically good. It may represent comfortable liquidity, or it may represent inventory that cannot be sold. A high margin is not automatically superior to a low margin because industries use different economic models. A discount retailer can succeed with thin margins and rapid asset turnover. A software company may rely on high margins and lower physical asset intensity. Third, use DuPont analysis to decompose return on equity. Instead of treating ROE as one mysterious percentage, we separate the result into profit margin, asset turnover, and financial leverage. The expanded version can also isolate tax burden and interest burden. This lets us ask whether shareholders earned a strong return because the company priced well, used assets efficiently, or employed more debt. Fourth, identify comparability problems. Inventory can be measured using different cost flow assumptions. Depreciation depends on useful life and residual value estimates. Acquisitions, restructuring charges, stock compensation, pension assumptions, leases, inflation, and foreign currency can affect comparisons across time and across firms. A ratio is only as comparable as the accounting and economics underneath it. These objectives connect into one workflow. We gather the statements and footnotes, normalize unusual items, calculate ratios, decompose the key drivers, compare the company with its history and peers, and then connect the evidence to valuation and risk. The assessments emphasize application, interpretation, and judgment. A strong answer does not merely say that inventory rose. It asks whether inventory rose faster than sales, whether turnover weakened, whether cash flow deteriorated, and whether the footnotes suggest obsolescence or a deliberate build for future demand. Financial statement analysis is not a hunt for one perfect ratio. It is a structured attempt to make the three statements tell the same story. When they disagree, that is usually where the interesting work starts. The module is organized around 4 connected questions. Question 1 is the statements. The income statement measures performance during a period. The balance sheet shows the resources controlled by the firm and the claims against those resources at a particular date. The statement of cash flows explains why the cash balance changed. The statements are connected. Net income contributes to retained earnings. Depreciation reduces accounting income, but is added back in operating cash flow because it is not a current cash payment. Capital spending appears in investing cash flow and later affects depreciation expense. Debt issuance supplies cash today and creates interest and repayment obligations later. Question 2 is profitability. We will examine return on assets, return on capital, return on equity, economic value added, profit margins, and asset turnover. Each measure asks a different question. Return on assets asks how effectively the asset base produces profit. Return on capital focuses on the capital supplied by debt and equity investors. Return on equity focuses on common shareholders, but it can be heavily influenced by leverage. Question 3 is DuPont analysis. The basic DuPont identity says that return on equity equals profit margin times asset turnover times the leverage ratio. The expanded system can separate the tax burden, interest burden, operating margin, asset turnover, and leverage. That decomposition turns a headline result into an economic explanation. Question 4 is quality and comparability. 2 companies can report the same earnings while using different estimates and accounting policies. One may use a longer depreciable life, a different inventory method, more aggressive revenue recognition, or more adjustments labeled non-recurring. Inflation can make old assets look inexpensive relative to current replacement costs. Acquisitions can make year-over-year comparisons messy. Segment reporting may reveal that one profitable division is subsidizing another. The 4 questions should be used together. The statements provide the raw evidence, profitability, and turnover. Organize that evidence. DuPont identifies the return engine. Quality review tests whether the engine is durable and comparable. Think of the process as moving from documents to diagnosis. We do not stop when a ratio is calculated. We ask what operating decision, accounting judgment, or financing choice caused it. The goal is a usable mental model, not a vocabulary list. Ratios are not answers. They are very efficient ways to ask better questions, which is fortunate because financial statements contain plenty of opportunities for questions. This slide places the chapter's core concepts in one view. The income statement reports revenues and expenses during a period. It begins with sales, subtracts costs, and arrives at measures such as operating income and net income. Because it uses accrual accounting, revenue can be recognized before cash is collected, and expenses can be recognized before or after cash is paid. That timing helps match economic activity, but it also introduces estimates. The balance sheet reports assets, liabilities, and equity at a point in time. Assets include cash, receivables, inventory, property, equipment, investments, and intangible assets. Liabilities include payables, debt, lease obligations, taxes, and other commitments. Equity is the residual claim. The familiar equation is assets equal liabilities plus shareholders' equity. The statement of cash flows explains cash receipts and payments through operating, investing, and financing activity. Operating cash flow begins with the economics of the business and adjusts for non-cash items and working capital changes. Investing cash flow includes capital spending and acquisitions. Financing cash flow includes borrowing, debt repayment, dividends, and share issuance or repurchase. Return on assets, or ROA, measures profit relative to the asset base. Return on equity, or ROE, measures profit relative to common equity. Those measures can point in different directions because debt changes the relationship between assets and equity. The DuPont system decomposes return on equity into profitability, efficiency, and leverage. That matters because two companies can report the same ROE while reaching it through very different economics. Suppose company A earns an 8% profit margin, turns its assets 1.5 times, and has assets equal to twice equity. 8% times 1.5 times 2 equals a 24% return on equity. Company B earns a 12% margin, turns its assets once, and also has assets equal to twice equity. 12% times 1 times 2 also equals 24%. The headline returns identical, but the business models are not. Company A relies more on volume and asset efficiency. Company B relies more on margin. A third company might reach 24% through much higher leverage and weaker operating economics, in which would deserve a very different risk assessment. A strong answer names the concept and explains how it changes the decision. The statements are not three unrelated documents. They are three camera angles on the same business. When one camera shows a much prettier picture than the others, do not blame the camera immediately. Investigate the scene. A disciplined financial statement analysis can be organized into 6 stages. Step 1 is collect. Gather the income statements, balance sheets, cash flow statements, footnotes, segment disclosures, management discussion, and several years of history. 1 year can be distorted by a cycle, acquisition, restructuring, or accounting change. The footnotes matter because the summary statements cannot explain every estimate, commitment, and policy. Step 2 is normalize. Separate recurring operating performance from unusual items. Review restructuring charges, asset impairments, acquisition expenses, litigation, gains on asset sales, pension effects, and stock-based compensation. Management may present adjusted earnings, but the analyst should understand exactly what was removed and whether the adjustment is truly unusual. When an expense is excluded every year, it has developed a suspiciously regular attendance record. Step 3 is compute. Calculate profitability, liquidity, leverage, turnover, coverage, and market ratios. Use average balance sheet values when the numerator measures activity across a period. Sales divided by average assets is generally more informative than sales divided by 1 year in snapshot. Keep numerator and denominator definitions consistent. Step 4 is decompose. Use DuPont analysis to locate the sources of return on equity. Is ROE improving because margins expanded? Did asset turnover rise? Did leverage increase? Did lower taxes or interest expense help? The decomposition converts a percentage into a business explanation. Step 5 is compare. Compare the firm with its own history, direct competitors, industry economics, and relevant cycle. A grocery chain and a luxury software company should not be judged by the same margin standard. Peer comparison also requires accounting comparability. Different depreciation, inventory, lease, and acquisition policies can create false differences. Step 6 is conclude. Connect the evidence to valuation, risk, and cash flow sustainability. A rising margin may support a stronger valuation if it reflects durable pricing power. It may deserve skepticism if it comes from underinvestment, temporary cost cuts, or capitalization of expenses. A higher return on equity may be attractive if operating performance improved. It may be fragile if debt rose sharply. This workflow protects against two common failures. The first is ratio tourism, visiting a few numbers without understanding the business. The second is story first analysis, deciding the conclusion and then recruiting whichever ratio is willing to cooperate. Process discipline makes the work repeatable. It also creates a record that can be reviewed later. The goal is not to prove that management is wrong. The goal is to understand what must remain true for the reported performance to continue. The key relationship is the DuPont decomposition of return on equity. In the basic three-part version, return on equity equals profit margin times asset turnover times the leverage ratio. Profit margin is net income divided by sales. It tells us how much profit remains from each dollar of revenue after operating costs, interest, and taxes. Asset turnover is sales divided by average assets. It tells us how efficiently the asset base produces revenue. The leverage ratio is average assets divided by average equity. It tells us how much of the asset base is supported by each dollar of common equity. Multiplying the three pieces gives net income divided by equity because the sales and asset terms cancel. That algebra is useful, but the economic interpretation is more important. Consider two firms that both report a 20% return on equity. Firm 1 has a 10% profit margin, asset turnover of 1, and leverage of 2. 10% times 1 times 2 equals 20%. Firm 2 has a 5% margin, asset turnover of 2, and leverage of 2. 5% times 2 times 2 also equals 20%. Firm 1 earns more on each sale. Firm 2 earns less per sale, but uses its assets more rapidly. A luxury brand and a discount retailer can both create attractive returns through different combinations of margin and turnover. Now consider Firm 3. It has a 5% margin, asset turnover of 1, and leverage of 4. That also produces 20% ROE, but the return depends much more heavily on debt and a thinner equity cushion. The same result now carries more financial risk. The expanded DuPont system adds more detail. Tax burden is net income divided by pre-tax income. Interest burden is pre-tax income divided by earnings before interest and taxes. Operating margin is earnings before interest and taxes divided by sales. Multiply those by asset turnover and financial leverage, and we can see whether taxes, financing cost, operations, efficiency, or leverage drove the result. This is especially useful when ROE changes. A rise from 15% to 20% sounds positive, but if the entire increase came from share repurchases funded with debt, the underlying business may not have improved. A smaller equity denominator can make the percentage look taller without making the company safer. DuPont analysis is not a scorecard that automatically rewards the highest number. It is a diagnostic tool. High ROE is attractive when it comes from durable margins, efficient asset use, and sensible financing. It is less comforting when leverage is doing most of the heavy lifting and breathing heavily. This slide compares accounting earnings with cash flow. Accounting earnings are based on accrual accounting. Revenue is recognized when earned under the applicable rules, not necessarily when cash arrives. Expenses are matched to the period in which they help generate revenue, not necessarily when cash is paid. This approach can provide a better measure of ongoing profitability than raw cash movements, especially when customer payments and supplier payments occur at different times. The same system also relies on estimates. Management estimates bad debts, warranty costs, useful lives, pension assumptions, inventory reserves, and the timing of revenue. Those estimates may be reasonable, optimistic, or occasionally creative enough to deserve their own art exhibit. Cash flow tracks money moving in and out. Operating cash flow can reveal whether reported profit is converting into liquidity. If net income rises while operating cash flow repeatedly falls, the analyst should investigate receivables, inventory, payables, deferred revenue, and non-cash gains. Negative operating cash flow is not automatically proof of a problem. A fast-growing business may invest in inventory or extend credit to customers. A seasonal retailer may build inventory before the holiday period. A company may pay suppliers early to capture discounts. The question is whether the cash use supports productive growth or hides weakening economics. Cash flow also has limitations. It can be lumpy. Capital expenditures may occur in large projects. Working capital can reverse from one quarter to the next. A company can temporarily improve operating cash flow by delaying supplier payments or accelerating collections. Classification choices can change where cash appears without changing total cash. That is why analysts often examine free cash flow, usually operating cash flow minus capital expenditures, while recognizing that maintenance and growth capital spending are not always easy to separate. A business can produce strong operating cash flow by underinvesting, but that success may not last. The best analysis reconciles earnings and cash flow rather than choosing one as the universal winner. Start with net income. Add back non-cash charges. Examine changes in receivables, inventory, payables, and other working capital accounts. Review investing cash flow to understand capital needs. Review financing cash flow to see whether debt, stock issuance, dividends, or buybacks funded the gap. Accounting earnings can smooth timing and reveal profitability. Cash flow can reveal funding pressure and sustainability. Neither deserves to work alone. Earnings tell us what the accounting model says was earned. Cash flow tells us how the bank account reacted. A healthy business eventually needs both stories to meet in the same neighborhood. Modern financial statement analysis is faster, more standardized, and more automated than it was a generation ago. The judgment problem has not disappeared. Public company filings are available in structured formats such as XBRL. Data vendors can place years of statements, ratios, consensus estimates, and peer comparisons on one screen. Screening tools can identify companies with rising margins, improving returns on capital, or deteriorating liquidity. Artificial intelligence can summarize filings and search footnotes. Those tools save time. They do not decide whether the accounting reflects durable economics. What changed? Analysts can process more companies and more data with less manual entry. Alternative data can help test revenue trends, customer activity, pricing, and inventory movement. Models can detect unusual accruals or changes in disclosure language. The research workflow is more scalable. What stayed the same? The footnotes still contain the definitions. Revenue recognition, leases, stock compensation, pensions, acquisition accounting, taxes, inventory reserves, supplier finance arrangements, and segment changes still require interpretation. A clean ratio table can hide messy economics if the inputs were accepted without question. Who benefits? Investors benefit when technology reduces clerical work and makes comparisons easier. Management teams benefit when they can communicate performance more clearly. Auditors, regulators, and boards benefit from stronger data tools. Vendors benefit too, which is worth remembering when the subscription invoice arrives with institutional confidence. What risk remains? Automation can reproduce an error at impressive speed. Standardized fields can create false comparability. A model may treat every restructuring charge as unusual even when restructuring has become a recurring management style. Non-GAAP metrics can remove real costs. Stock-based compensation may not use cash today, but it can dilute shareholders. Capitalized software costs can improve current earnings while pushing expense recognition into the future. Market conditions also change what investors emphasize. During periods of cheap capital, companies with strong revenue growth and distant profitability may receive patience. When rates rise and financing becomes expensive, cash burn, debt maturity, covenant headroom, and free cash flow become much more important. In 2022, investors rediscovered cash flow with the enthusiasm of people locating an umbrella after the rain had already started. The modern analyst should use technology aggressively and trust it selectively. Let the software calculate. Let the screen identify patterns, then read the filing, reconcile the statements, and ask what economic reality produced the number. Automation can calculate ratios. It cannot decide whether a company improved its economics or simply improved the presentation. That remains a human assignment. Let us apply the chapter to the retailer on this slide. The company reports rising sales and net income, which sounds encouraging. At the same time, operating cash flow is negative and inventory is rising faster than sales. That combination does not prove the company is in trouble, but it creates several questions that should be answered before celebrating the earnings headline. First, which statements reveal the issue? The income statement shows the sales and profit trend. The balance sheet shows the growing inventory balance and any related increase in payables or debt. The cash flow statement shows that operations are consuming cash. The footnotes explain inventory policy, valuation allowances, markdowns, vendor arrangements, and any change in classification. Second, what ratio should we investigate? Inventory turnover equals cost of goods sold divided by average inventory. Days inventory equals 365 divided by inventory turnover. We should compare those measures with prior years and peers. Suppose, only as an illustration, that cost of goods sold is $700 million and average inventory is $240 million. Inventory turnover would be about 2.9 times. That implies roughly 125 days of inventory. If the prior year turnover was 3.4 times, or about 107 days, inventory is moving more slowly. That could mean weaker demand, over-ordering, product obsolescence, a deliberate seasonal build, or preparation for new store growth. The ratio identifies the issue. It does not choose the explanation for us. Third, why could return on equity mislead? ROE may rise because net income increased, but it may also rise because equity declined after share repurchases or because leverage increased. If the retailer borrowed money to finance inventory and buy back shares, the return on the remaining equity could look better, while liquidity and financial risk worsened. DuPont analysis would show whether margin, turnover, or leverage drove the change. Fourth, which footnote or accounting policy deserves review? Inventory valuation is a priority. Review whether the company uses FIFO, LIFO, or another method. Examine markdown and obsolescence reserves. Look for changes in gross margin assumptions, supplier incentives, returns, and shrinkage. Review revenue recognition and gift card liabilities. Check whether supplier finance arrangements altered operating cash flow or the apparent timing of payables. The recommendation should be conditional. Do not reject the company automatically. Investigate before relying on the earnings growth. The inventory build may support credible expansion or a seasonal sales opportunity. It may also signal that products are not moving and future markdowns will pressure margins. A strong answer connects the statements. Sales rose, inventory rose faster, cash flow weakened, and ROE may have been supported by leverage. The remaining question is whether the inventory represents future revenue or yesterday's optimism in cardboard boxes. Pause the video here and write a one-sentence investment conclusion, 2 pieces of evidence, and 1 fact that would change your conclusion. This slide lists common mistakes, and each one is preventable. Mistake 1 is treating ratios as answers rather than prompts. A ratio describes a relationship. It does not explain the cause. A falling current ratio may indicate liquidity pressure. or it may reflect efficient working capital management. A rising margin may reflect pricing power, a favorable product mix, temporary cost cuts, or underinvestment. Mistake 2 is comparing margins across industries without context. Grocery stores often operate with thin margins and high turnover. Software companies may operate with higher gross margins and lower physical asset needs. Banks, insurers, manufacturers, utilities, and retailers use very different balance sheets. Industry economics determine what normal looks like. Mistake 3 is celebrating return on equity driven only by leverage. Debt can increase shareholder returns when operating returns exceed financing costs, and it also increases fixed obligations and downside sensitivity. Share repurchases can reduce equity and raise ROE even when net income is unchanged. The percentage may improve while the cushion becomes thinner. Mistake 4 is ignoring cash flow when earnings look strong. Repeated growth in receivables or inventory can absorb cash. Capitalized costs can raise current earnings. Asset sale gains can improve income without improving the operating engine. Earnings quality improves when profit converts into cash over time. Mistake 5 is overlooking inventory and depreciation methods. FIFO and LIFO can produce different inventory values and cost of goods sold during inflation. Longer estimated asset lives reduce annual depreciation expense and raise current profit. Changes in assumptions can alter trends without changing the physical business. Several additional mistakes deserve attention. Do not use a year-end balance sheet for every denominator when the numerator covers an entire year. Average assets, inventory, receivables, and equity are often better matches. Do not mix accounting definitions. If operating profit is in the numerator, use operating capital in the denominator. If comparing companies, confirm that lease obligations, pensions, minority interests, and acquired intangibles are treated consistently. Do not accept every non-GAAP adjustment as harmless. Some adjustments are useful. Others remove recurring costs because recurring costs make the story less photogenic. Do not ignore dilution. Earnings can grow, while earnings per share grows more slowly because the share count rises. Do not assume that a high cash balance means excess cash. Some cash may be required for operations, restricted, located in another jurisdiction, or offset by near-term obligations. Finally, do not confuse precision with accuracy. A ratio to 3 decimal places is still built on accounting estimates and economic assumptions. A ratio is a question generator wearing a decimal point. Use it to locate the issue, then return to the statements, footnotes, business model, and valuation. Here's the knowledge check. The DuPont system helps explain return on equity by decomposing it into which components. Choice A says profitability, asset use, and leverage components. Choice B says only dividend yield. Choice C says only market capitalization. Choice D says the number of shares outstanding. Pause for a moment and choose the best answer. The correct answer is A. The basic DuPont identity expresses return on equity as profit margin times asset turnover times financial leverage. Profit margin measures the amount of profit earned from sales. Asset turnover measures how efficiently assets generate sales. Financial leverage measures the relationship between assets and common equity. The expanded DuPont system can add tax burden and interest burden, allowing the analyst to distinguish operating performance from financing and tax effects. Choice B is incorrect because dividend yield is a market return measure. It does not explain how the company generated return on equity. Choice C is incorrect because market capitalization is the market value of common equity. It may be relevant to valuation, but it is not one of the operating components in the DuPont identity. Choice D is incorrect because the share count can affect earnings per share and may indirectly affect the equity base through repurchases or issuance. But the number of shares outstanding is not the DuPont decomposition. The practical point is more important than the multiple choice answer. If two firms have the same return on equity, DuPont analysis tells us whether they arrive there through margin efficiency or leverage. That distinction changes the risk assessment and the valuation argument. The correct answer is A, profitability, asset use, and leverage components. Let us close chapter 14 with 3 takeaways. First, financial statements provide evidence, not certainty. The income statement, balance sheet, and statement of cash flows are connected, but each uses classifications and estimates. The analyst's job is to reconcile the 3 statements and understand the accounting policies behind them. Second, ratio interpretation requires industry and accounting context. A high margin current ratio or return on equity is not automatically good. The result must be compared with the business model, peers, history, cycle, and the accounting choices used to produce it. Third, cash flow and balance sheet quality can contradict an earnings headline. Profit growth is more credible when it converts into cash, does not require unsustainable working capital, and is supported by a resilient capital structure. The homework after this chapter is the financial statement, red flag memo, a strong submission, should identify the key issue, calculate or interpret relevant ratios, connect the income statement with cash flow and the balance sheet, and state what additional evidence would change the conclusion. The discussion asks, which ratio matters most? The best answer will resist choosing one universal winner. The most useful ratio depends on the business and the decision. A lender may focus on coverage and liquidity. An equity investor may focus on returns on capital, margins, cash conversion, and leverage. A retailer and a software company should not be forced into the same analytical costume. The quiz contains 10 automatically graded questions on the statements. Profitability, turnover, liquidity, leverage, DuPont analysis, and comparability. Before finishing any analysis, ask the question on the slide, what would change my recommendation? Would the inventory sell without markdowns? Would receivables convert to cash? Would margins remain after temporary cost cuts reverse? Would debt refinancing become more expensive? Would a change in depreciation policy alter the comparison? Would a segment disclosure reveal that growth came from a lower quality business? Writing those conditions in advance turns a ratio report into an investment process. The next chapter moves into options markets. That may seem like a sharp turn, but the analytical habit carries forward. Options depend on the value and volatility of the underlying asset. Financial statement analysis helps investors understand the business risks that can create those outcomes. Remember the central lesson. A company can report excellent earnings, an attractive return on equity, and a polished investor presentation. The investor still needs to ask how the profit was earned, whether it became cash, how much capital was required, and what risk remains on the balance sheet. Financial statements do not speak for themselves. Management speaks through them. Accounting rules shape them, and investors must interpret them. The numbers are the beginning of the conversation, not the final word.